John. We're so excited to have you back on Stock Shots. Thanks for being with us.
Well, thank you for having me, James.
John, last time we talked was back in May, and you were still contending that M3 was growing at an alarming rate.
Yeah.
Now we're hearing a lot of people in the mainstream media give the deflation chant. Can you share your perspectives on where we are with inflation or deflation?
Sure. My general outlook has not changed at all. I mean, I'm looking for serious inflation this year that very easily and quickly could become a hyperinflation, and will become a hyperinflation within the next 5 years or so. Again, possibly as early as this year. Let me just define a couple of things up front. In terms of deflation, I'm talking the prices of goods and services, and the way that's traditionally looked at is year-to-year decline in the prices of goods and services. The CPI, for example, would be considered deflation. We actually came very close to seeing that in December, where the year-to-year rate of inflation dropped to 0.1%. In fact, I'm not so sure it didn't actually go a little bit below the way they put it together, but I think they very much wanted to keep it on the plus side so that they didn't have to worry about people saying, oh my goodness, we've got deflation. There were other numbers that actually were down year to year, and if we're seeing some formal deflation, it is going to be very short-lived, and it's not the type that people tend to think about when they look back to the Great Depression. What's happened here is you had a collapse in oil prices. And I think part of that probably was part of the political process coming up to the election, aimed at getting gasoline prices to fall. Oil and gasoline prices plummeted. Inflation followed the gasoline prices. And I think what we saw in December was probably the bottom of the cycle in terms of the slowing annual inflation. Here we are in the third week of January, and we're seeing already gasoline prices are up from December. Oil prices are up from December. And as you go down the road, I would look for oil and gasoline to rise despite the very severe economic downturn. Downturn globally in business activity does reduce the demand for oil, but OPEC also is cutting production, which tends to offset that. The determining factor going forward on oil prices, I believe you'll find to be the U.S. dollar. That's been up and down, and I'll contend faces a major decline in the not-too-distant future. And as the dollar declines, dollar-denominated commodities such as oil tend to spike in prices, and that'll tend to spike oil prices. But on a much broader basis, I mean, again, the drop in inflation in the aggregate number has been due primarily to this extraordinary drop in gasoline prices. Everything else is still up as pretty much as it was year to year. The problem going forward, the problem right now is money supply and what they call the velocity of money, how quickly the money supply turns over in the economy. Now, if you go back to March, money supply growth in the broad measure, M3, which I still track as I estimate it. Fed stopped publishing that back in 2006, but most of the components still are published. It actually got up to, after some revisions that were published last night, 17.2% annual growth in February, or March, I guess it was March. That was the highest seen since June of 1970, two months before Richard Nixon abandoned closed the gold window and instituted wage and price controls. That's a very highly inflationary level. Since then, the annual growth of money supply slowed as the banking crisis, the banking solvency crisis, intensified as banks were not lending new cash into the system. You just weren't getting standard growth in the money supply, and the annual growth generally continued to slow. A contraction in debt outstanding, debt collapse, defaults, that doesn't really affect money growth, because once a bank lends money, the money goes into the system, and if the bank has to wants to try and recover it, usually it can't. So that although lending the money expands the money supply, when someone defaults, the bank just can't grab it and pull it back out of the system, collapsing the money supply. That just doesn't happen. So that it's the rate of new loan growth that tends to dominate what's happening there. And what we saw was that from the 17.2% peak back in March, that we got down to a trough of about 9.8% in November. That's still strong money growth. But we began to see in December that some of the extraordinary actions taken by the Federal Reserve were beginning to kick in. Now, when the Federal Reserve targets money supply growth, which they have been doing here, their traditional tool is what's called the monetary base. They can affect that because it includes basically currency in circulation, which is the dominant component, and bank reserves, what banks deposit with the Fed in order to support the accounts that they hold. And what we saw in the most recent reporting is that the monetary base is up year over year something like 110%. I've never seen a level like that. Part of that growth is due to what they refer to as excess reserves. These are reserves that the banks don't have to deposit with the Fed, but because the Fed's paying them some interest rates, they are. And these are funds that are not otherwise being lent out into the normal flow of commerce. However, the required reserves also have been growing, and they're up over almost 40% year over year, again, the highest level ever seen. And that reflects, indeed, some increase in bank lending. It reflects a growth in the accounts that get counted in the money supply, and in the broad money supply measure, the average for annual growth for December, for the average December of 2008 over 2007, was up 11.4%. We've seen that starting to grow again. And going forward, I think you're going to see that pace accelerate. In terms of what affects the velocity of the money, the turnover of the money in the system, where people have had cash under their mattresses, that cash hasn't been circulating. What we're beginning to see here are indications that some of the cash is coming out from underneath the mattresses. The problem is that you can't make any money with it. Yields on Treasury bonds are so low that they're negative in inflation-adjusted terms, except for what was seen in December, which is an extraordinary month. That's going to change around very, very quickly. But generally, people can make more money by going out and spending their money than by investing it. And when you see that happen, generally they don't hold on to the cash. They tend to increasingly buy goods, and it speeds up the rate at which the cash gets turned over. We're seeing broad money growth, and those two factors together tend to promise much higher inflation down the road.
For the rest of this great interview, visit our website, www.stockshots.tv. That's www.stockshotz.tv. Thank you for listening.